Good morning. It's Jeffrey Christian from CPM Group in New York. It's about 11:15 in the morning on Friday, the 15th of October. I wanted to talk to you today about gold and inflation. I think in Tuesday's video, I said I would address this issue because people wanted us to address it, and it is becoming a hot topic in the market. I said I would address it today, and then next Tuesday, I hope to, unless something intervenes, talk about recent patterns in central bank gold purchases. Very strong March, April, May, and much weaker on both a gross and net basis over the last 3 or 4 months. Talk about that next Tuesday. Today, I wanted to talk about gold and inflation. And I've got several things. I want to talk about realism in terms of inflation. I want to talk about what rational expectations are in terms of inflation. And then I'll also talk about the relationship between gold prices and inflation. Because I think there's a lot of misunderstandings about what inflation is and how it runs and how it feels, past, present, and the future. And there's also a lot of misunderstanding about gold and the relationship between gold and inflation. Now, I talked recently about how we look at different drivers for investment demand, and one of them is inflation. And I pointed out that inflation really hasn't been a major factor stimulating investment demand for most of the last 40 years. Inflation expectations on the part of some investors have. But if you look at the things that have caused investors to say, I'm a little bit uncomfortable here and I think I want to buy gold, it's been the dollar, it's been overall financial market instability, bank problems, stock market declines, and other economic factors rather than inflation. And you can see here, gold prices have risen sharply in the last 20 some odd years since 2000, even as inflation has remained low and actually moved lower. If you look at the statistical correlation of changes in inflation versus changes in gold prices over the period 1970 to 2020, so roughly the period of free gold prices, which really started in 1968, it's a 9% correlation. So it's not a particularly strong thing. If anybody who says that gold is an inflation hedge is right. Anybody who says that gold prices move lockstep with inflation, and if inflation rises, gold should rise. If inflation doesn't rise, gold shouldn't rise, doesn't understand the relationship. So over the vast half century of free gold prices, we've seen a 9% correlation. If you just look at the last 20 years as gold prices were rising and inflation was actually flat to lower, it's about a 1% correlation. And if you just look at it since 2008, when the financial markets changed, excuse me for a second, I'm sorry about that. If you just look at the relationship since 2008, it's a negative 5% correlation. So the good news is it doesn't take high inflation for gold prices to rise. And I think that's very important because we don't see inflation being particularly bad. Now, I love this quote. It's from Roy Jastrom's The Golden Constant. And he wrote that book in 1977. And as is the style in publishing, the publishers took the title, made the title The Golden Constant, and started marketing it before they'd read the book. The book says, here's history of gold prices since 1700 in the UK and 1800 in the United States. And if you look at it, there is not a golden constant. Gold's purchasing power has varied sharply, 8-fold from the bottom to the top over that period of time. And the purchasing power of gold actually has fallen. If you look at gold on an inflation adjusted basis, at today's price and all, in 1700, gold would have been about $5,500 an ounce, falling down to only 1750, 1760 today. So gold's purchasing power is not constant, and it fluctuates sharply, and it has deteriorated over time. And that was the statistical conclusion of Roy's work. And Roy was a great mathematician. The book was called The Golden Constant because the publisher said, oh, he's talking about the golden constant. And they didn't read the book. It's the same way in 2005, I wrote a book called Commodities Rising. I didn't choose that title. I wanted to call the book Stuff and talk about investing in commodities. But the publishers needed to publicize the book before I wrote it. And they chose the title Commodities Rising. The book came out and it said, hey, super cycle is nothing but marketing hype. These things are going to peak in a few years and come down. Let's have a rational view of commodities. So Roy had this book, The Golden Constant, and this is, actually a copy of the conclusion, where he says this: gold is really good to protect you against cataclysmic cases of high inflation, but it doesn't do well against that day-to-day gnawing 1%, 2%, 3% inflation. And you've heard me say this over and over again, and it's true. And how it is that someone makes a jump, or the society makes a jump and says, oh, gold is good against catastrophic inflation, ergo it is good against day-to-day gnawing inflation, is subject for psychologists, not economists. There's an old song, 40,000 Frenchmen can be wrong. That may be true, but hundreds of millions of gold market commentators can be wrong, and often are. It's the delusion of crowds. And it's one of those things that's just accepted, even though statistically it just isn't there. Now, the past. Somewhere I picked up this quote: there was no inflation under the gold standard. And I know there are a lot of people who believe it. I thought I knew where that statement came from, but I couldn't find it in that book. But here it is. And this is data from Roy Jastrom's book, The Golden Constant. These are the percentage changes year over year in UK inflation using the PPI, because there wasn't a CPI going back to 1700. So the inflation indicators that he found that he could use were producer price index for the United States and for the United Kingdom. This is the percent change in inflation as measured by the PPI under the gold standards from 1700 to 1970. We cut it off at 1970 in order to really focus on what happened with inflation under a gold standard. Now, there were periods of time when the UK came off of the gold standard. One of them was 1803 to 1821 during the Napoleonic Wars. One of them was 1914 into about 1925 before they went back on after World War I. And then 1931 through 1944, which was the Great Depression and World War II. So there are periods of time that you see, spikes up because of wars, and they weren't on a gold standard. But if you take that out and you just look at the rest of it, you see massive periods of high inflation, 10%, not uncommon inflation. 20% was only achieved a couple times, but you had 10 to 20%, getting up there in that 15, 16, 17, 18% annualized rate quite often. But you also had massive periods of deflation. You also had recessions and depressions under the gold standard. And so yes, there was inflation under the gold standard. It was true in the UK. And if you look at the US, which only goes back to 1800 because the country didn't exist until 1782, 1792, depending on where you want to measure it, the start, you can see a very similar pattern. Periods of high inflation, periods of high deflation, recessions, and depressions. And when I was interviewing Alan Greenspan, for like a 2 or 3 hour period in early 2019 for a Hong Kong client, Royal Capital, I asked Alan, I said, Alan, you look at the empirical evidence and you see periods of deflation, periods of depression, periods of high inflation under a gold standard, and yet you say that a gold standard probably was a good thing. And he said, well, of course you had periods of high inflation and high deflation because you were in a species, and the economy would not have enough gold, and you'd have this inflationary pressure, and then that would bring in a lot more gold, and you'd have a deflationary period. So yeah, of course, if you're going to have a gold standard, you're going to have periods of high inflation and high deflation, and you're going to have depressions, which is why central banks and other monetary authorities and governments said we probably should move away from the gold standard. And you've seen the charts since that time that you've actually had a much less volatile overall economy in terms of inflation, in terms of recessions, and depressions. So the myth that there was no inflation under a gold standard and it was some halcyon days of the good old days, it's just a myth. And yet it's a very persistent myth. Inflation today, going back to this chart, again, inflation was very high in the 70s. Paul Volcker came in 1979 as Fed chairman and changed the rules of the way monetary policy was done, targeting inflation instead of interest rates. And we had one last burst of inflation, and then it came down, and it's been low ever since by historical standards. And I'll point that out. It's picking up now, and it's spiking. The Fed has said it's transitory. Some people don't believe them. If you look, we did have a couple periods of inflation spiking up in the late 1980s and then again around 2008. But you've seen an extended period of time where inflation has been relatively low. And let's talk about how low it is. Well, before I get to that, that's the future. These are the 1 month percentage changes, and we've talked about this in the past. Everyone looks, yesterday or the day before CPI came out for September, 5.4% year-over-year increase in headline inflation, 4% increase in core inflation, excluding energy and metals, food, energy and food. But that's year-over-year. If you look at it on a month-to-month basis, 0.4%, I think it was, for headline, and 0.2% for core inflation, excluding food and energies. 40+% increase in oil prices and oil distillates and gasoline, and everything else was relatively low. Used car sales prices, which had been very high in the second and third quarters of this year, or second into the third quarter of this year, they were off 1.5% in August, and they were off another 0.7% in September. So you're seeing the extent to which that surge in inflation March through June was in fact transitory. And this chart, which is from the first page of the CPI report. So if you're actually serious about understanding what the Bureau of Labor Statistics is saying about inflation, you're going to get this 37-page report. It's free, it's available on the internet, and you're going to read it. And on the first page, you see this chart, which is sort of like a punch to the face of anybody who says the Fed doesn't know what it's doing, it's losing control, inflation is surging. We're going to see 20% inflation, an era of 20% inflation, one guy called it on the internet this week, right? Punch gut right in the face, hey, dudes, inflation on a month-over-month basis is half of what it was during that spike. And then you go forward and you're going to be looking at both year-over-year and month-to-month inflation rates being much lower next year. So that's where we are with inflation. It's not as scary as some people want you to think. But then they probably haven't even looked at the first page of a 37-page report that tells you what's going on in the US in terms of consumer price inflation. They don't need those details. Inflation tomorrow. Like I said, you're hearing 20%, an era of 20% inflation. Now, when I think of an era, well, I think about geologic eras, but I also think about like rock and roll eras, that 5 years there, the 5 years, the 6 years when the Beatles were really at the top of their form before they broke up. That's an era, right? If you look at US CPI, what you can see is, and maybe you can't see it, this is 5%, this is 10%, this is 15%, 20% isn't on this scale. Now, this only goes back to 1947. I showed you the historic data from 1800 to 1970 earlier. This only goes back to 1947. And you can see that we had some really nasty periods of time. We have 14.8% inflation in 1980, at the beginning of end of 1979, beginning of 1980, 12% in 1975, 74, and a couple of periods where it got up to 10% in the post-war period, and then in the mid-50s. We haven't seen 20% inflation. And when we've seen 10% or 12% or 15%, it's lasted for a month or two, hardly an era. So anybody who's talking to you about an era of 20% inflation, he's looking at something that's not on the chart. And he's not looking at something that's not on the charts from 1947 to the present, because as I showed you earlier, going back to 1800 in the United States and 1700 in the UK, we've seen spikes up toward 20%, but we haven't seen an era of 20%. So it doesn't really look good. Now you can say, okay, well, those earlier charts were PPI, not CPI, and PPI is more volatile than consumer prices, and we are seeing a more dramatic increase. But it's not necessarily there. This is real research. It's what CPM Group does. I was having some fun with my colleagues this week. We saw one of these guys who was pushing the silver squeeze earlier in the year, and he did a video this week, basically saying anybody who was buying silver early in the year based on the silver squeeze was buying silver for the wrong reason, even though he was one of the biggest proponents of trying to squeeze the market. And then he said this classic line, no one should buy silver with the expectation of making money. This is a guy who sells silver for a living. And he does very well because he charges a high premium. But I don't know that he really is marketing very effectively. We tell our clients how they can save money, preserve their wealth, and make money investing in gold and silver. And you can, and you should not settle. You should say, how can I use gold and silver most effectively in precious metals? I showed you on the front page a copy of our Gold Yearbook. It's got a lot of information that will help you understand how the gold market really works and how it really interacts with the global and national economies. And it's a great gateway to using CPM Group to not only preserve your wealth, but to appreciate the value of your wealth with precious metals. Have a good weekend. I'll talk to you next Tuesday. Unless something intervenes, we'll be talking about central bank gold purchasing practices over the last year or two. Have a good weekend.